dive right into this week's deep dive. You guys sent over this article about companies that are well-positioned to benefit from the recent rate cuts by the Fed. And I gotta say, whenever the Fed makes a big move like this, my ears perk up. It's like watching the starting pistol for a market-wide race.
Yeah, it really does set off a chain reaction across the board, doesn't it?
Totally.
Yeah.
So break it down for us. Why are these rate cuts such a big deal for investors? What's the significance here?
Well, you got to think about it this way. When the Fed cuts those rates, borrowing money suddenly becomes cheaper. And that's huge for businesses looking to maybe expand, invest in new equipment, or even hire more employees. All those things suddenly become much more feasible.
Right.
And then on the consumer side, you see those lower interest rates translating into lower borrowing costs for things like mortgages, car loans. And that, my friend, puts more money back into people's pockets.
Okay, so it's like this boost of spending power for both businesses and consumers. Gotcha. But that seems pretty broad. This article hones in on some specific companies that are uniquely positioned to kind of ride this wave. We're talking big names: Nike, Chesapeake Energy, SoFi, even a bond play with the iShares 20-year Treasury Bond ETF. What makes these players stand out from the crowd in this scenario?
Well, what I find fascinating is that these companies are not only fundamentally strong, we're talking good track record, solid financials, but they also have these specific tailwinds working in their favor in this new rate environment. The article makes a case that they're in the right place at the right time to see some significant gains.
Right place, right time. Man, that's the sweet spot all investors are chasing. Okay, let's unpack these picks one by one. First up, we've got Nike. It's a household name for sure, but their stock has been a tad volatile lately. The article mentions Bill Ackman grabbing up shares, so clearly some big players see potential. What's the bull case here?
Well, there seems to be a disconnect between Nike's recent performance and the optimism from some of these investors. The last quarter, rough, no doubt about it. Slowdowns in China, U.S. consumer sentiment not looking too good. It wasn't pretty, to say the least. But some analysts are looking at this dip as a buying opportunity.
Really? A buying opportunity? What are they seeing that maybe others are missing?
Well, the analysts over at Sanford C. Bernstein, for example, they've slapped a $109 price target on Nike. Yeah, and that represents a potential upside of more than 30% from where the price is currently sitting. They're banking on a rebound.
30%, that's significant. Are there any other indicators out there supporting this kind of bullish sentiment?
That's the interesting part. When you look at the short interest in Nike, it's down almost 15% recently. And that suggests that even those who are betting against Nike are starting to lose a little bit of confidence.
So it's like this tug of war happening with Nike, right? Some seeing weakness, others sensing opportunity. This rate cut may just be the catalyst to tip the scales. Speaking of potential catalysts, let's move on to our next contender, Chesapeake Energy. This is where things get really interesting for me. What I find intriguing here is how the article connects Chesapeake to Warren Buffett's massive bet on Occidental Petroleum. Are we looking at the oil play of the year for the savvy investor? It's definitely got people talking. But the article makes this subtle yet really important distinction. It's saying that retail investors, like the folks listening right now, they actually might have an advantage when it comes to tapping into this trend.
Absolutely. The article suggests looking at smaller companies higher up the value chain than, say, Occidental Petroleum, which, let's be honest, is a behemoth with its fingers in a lot of different pots. Chesapeake, on the other hand, laser focus.
Okay, for those of us who haven't quite dedicated our lives to the intricacies of the energy sector, what does it actually mean to be higher at the value chain, and why is that so significant right now?
That's a fantastic question, and it's something a lot of investors struggle with. To put it simply, think of it as being closer to the source, more directly involved in the exploration and production of the oil itself. If these rate cuts spark that surge in oil demand that analysts are predicting, Chesapeake is poised to reap a more direct benefit than a company like Occidental that's spread a bit thinner, so to speak.
So it's less about the size of the company and more about their specific position within the sector, their strategic focus?
Exactly.
Got it. What else points to Chesapeake being a potential winner in this new world of rate cuts?
Well, for one, the analysts at Stephens have a $118 price target on Chesapeake right now.
Really?
Yeah, and that's a pretty bold statement if you ask me, reflecting a potential gain of more than 50% from where the price currently sits.
Okay, you've got my attention. Smaller company, more targeted exposure to a potential oil demand boom, and some pretty bullish analysts in their corner. I'm starting to see the appeal here. Let's shift gears now to a company that, honestly, you can't avoid these days, SoFi Technologies. They've been everywhere with those personal finance ads. What makes them a standout? in this new world of lower interest rates?
SoFi is really interesting because they're a huge player in mortgage lending, right? And as we talked about earlier, those lower interest rates tend to translate into, you guessed it, lower mortgage rates, and that could be a game changer for a company like SoFi.
More home buyers, more mortgages. More business for SoFi. Seems like a pretty direct line.
Exactly. And it's not just like a hunch. Wall Street analysts are forecasting, get this, a 7-fold increase in SoFi's earnings per share. Now, that's the kind of dramatic growth that gets investors excited.
7-fold. Yeah, that'll turn some heads. It's not something you see every day. It sounds like SoFi is strategically positioned to turn these rate cuts into some pretty serious profits.
Are there other signals out there, maybe from other big players, that support this kind of bullish outlook? 100%. Dimensional Fund Advisors, a massive institutional investor, just significantly increased their holdings in SoFi. And when a firm of that caliber makes a move like that, well, it says a lot about their confidence in the company, wouldn't you say?
Actions speak louder than words.
Yeah,
Right.
okay.
So POFI is officially on my radar now. For our final pick today, we're switching gears completely. We're jumping from sneakers and oil to wait for it bonds, the iShares 20-year Treasury Bond ETF, to be exact. Help me out here. What makes this ETF a standout play in a world where interest rates are falling?
This one often throws people off. It can seem a little counterintuitive, but there's a very deliberate strategy at work here. And it all comes back to that chain reaction we were talking about earlier. The article I sent over highlights a move by Stanley Druckenmiller, a legend in the investing world that I think you'll find fascinating.
All right, you've piqued my curiosity. Who is Stanley Druckenmiller, and what in the world does he have to do with bonds?
Well, Druckenmiller, he's known for his incredibly successful track record, you know? He was instrumental in George Soros's quantum fund.
Right.
So when this guy makes a move, Wall Street definitely takes notice.
Yeah, for sure.
And guess what? He just completely shifted his portfolio.
Oh, really? What do you do?
He pulled out of the U.S. tech sector in favor of, get this, bonds.
Bonds. No kidding. You don't hear that every day, especially with all the buzz around tech these days.
Yeah.
What's the strategy there? Why make that move now?
It all boils down to the relationship between interest rates, bond yields, and bond prices. It can be a bit of a head-scratcher, but basically when those interest rates go down, existing bonds suddenly look a lot more attractive, which then pushes up their prices.
So it's like this inverse relationship they have, right? Druckenmiller's thinking is as the Fed continues cutting those rates, bond yields will keep dropping and bond prices are going to keep rising.
Bingo. You got it. And the iShares 20-year Treasury Bond ETF, TLT for short, that's a direct way to tap into that potential upswing.
Wow.
If Druckenmiller's right, and let's be honest, he usually is, and that Fed keeps cutting, TLT could be looking at some serious gains.
This is incredible stuff. It's amazing to me how one decision from the Fed can have these ripple effects across completely different sectors of the market. It's like this domino effect, right?
Yeah, and it highlights something that's super important to remember. It's not just about reacting to the rate cuts themselves. The real key is being able to anticipate those second and third order effects, you know?
Exactly. That's what sets apart those casual investors from, well, the Stanley Druckenmillers of the world. It's about being able to really understand those connections, anticipating those ripple effects. And you know what I find so valuable about this article? It takes a concept that can feel really complex, interest rate cuts, bond yields, and makes it practical, actionable for everyday investors. It's not just theory. It's about saying, okay, here are specific companies' investments you can look at that are poised to benefit.
100%. And that's what makes these deep dives we do so important. It's about equipping you, giving you the tools to take this information and do something with it. Make it work for your own portfolio, you know? And while this article gives us these 4 fantastic picks to get started, it also does something else. It opens up a whole world of possibilities to explore.
It's true. And speaking of exploring those possibilities, you mentioned earlier that rate cuts have these global implications. The article focused on the U.S. market, but where else could investors be looking for opportunities?
Now, that's the million-dollar question, isn't it? What companies across the globe are sitting in a prime position to benefit from all of this? Are there international companies mirroring what we're seeing with Nike, Chesapeake, SoFi, or even those bond plays? It's almost like this treasure hunt, right? Trying to find those hidden gems that maybe everyone else is overlooking.
I love that. It's like a call to action for all our listeners out there.
Yeah.
Don't just file this information away, folks. Let it spark your curiosity, get you asking those important questions, and keep those deep dives going on your own.
Couldn't have said it better myself.
Yeah.
That's the beauty of investing, isn't it? There's always more to learn, new connections to be made.
Absolutely. Sometimes all it takes is that little nudge in the right direction to reveal a world of possibilities.
Exactly.
A nudge, and maybe a good pair of hiking boots for all that digging. That's a wrap on this deep dive. Until next time, everyone, keep those brains engaged, keep those questions coming, and keep diving deep into those markets.